We've talked about the effect the disaster in Japan is having on equities, commodities, even currencies, but we want to take a look now at the impact it's having on corporate bonds. Our next guest says that the reaction has been muted, but that started to change a bit today. Joining us right now to talk about this is Michael Mutti. He's senior credit strategist over at Raymond James. Michael, good to have you here with us.
Thank you, Carol. Good to be back.
So tell me how much of a change we saw today.
Well, like you said, it was muted since the earthquake originally occurred late last week. And today was the first sign, and that's to be expected. When the Nikkei goes down 10% and equities start off being down 300, spreads widened out more significantly than they had late last week.
So is it just a knee jerk?
I think so. Initially, this is a timing issue. There are a lot of events, whether it be the insurance industry or the energy industry, which were the two most heavily impacted in the corporate bond arena. It's going to take time to see what is going to sort out in those industries as to what the costs are going to be for the insurance sector and what the additional costs may be for the energy sector, and specifically the nuclear power related energy sectors.
So what do you expect to see? I mean, we were talking earlier with Mark Grant from Southwest Securities, and he said this is the time to bring all of your money back from emerging markets, wherever you have it invested in Asia, in the Middle East, and Europe, and buy basically corporate debt, or at least U.S. Treasuries for safety.
Well, I'm not surprised to hear him say that. There has been a great demand for corporate spreads and corporate bonds right now. I spoke with a customer last night, and he said, look, there's so much money out there that needs to be put to work, and I think that will be the case. It typically seems, Matt, when we have these type of occurrences, everyone wishes afterwards, like the BP and Anadarko situation, wow, I wish I had bought there. I shouldn't have been so quick to sell. That could very well be what we're seeing today. We've already seen people coming back in to start buying at the wide end of the spread levels.
So the risk trade not completely off then necessarily?
No, I wouldn't say so. I mean, we saw some deleveraging of risk, in some of the commodities. That's where I think a lot of the money went from commodities into treasuries this morning. Someone asked me that question: are people selling corporates to buy treasuries today? And we've already seen the markets come back in all those sectors. But I think initially it might have been more of a commodity to treasury trade than it was specifically a corporate bond to treasury trade.
When you talk about the longer term effects on energy companies, on insurance companies, I think about companies that are going to need to free up some cash, right? I mean, insurance companies especially may need serious liquidity. Is corporate debt sales a place that they go? I mean, do they get rid of what they're holding in order to pay off?
We may see some liquidations of holdings, particularly in some of the foreign companies. The Japanese holdings of some of these companies, they may be liquidating some of those, and they may be taking losses on some of those as well. But I think that there could be some liquidations, but thus far we have not seen any sign of that.
What about the repatriation? We heard Mohammed Al-Arian talk about the fact that at least Japanese investors are going to want to take money back to Japan, sell U.S. assets, U.S. corporate debt would I assume be one of the places they go.
We've seen the yen. The yen's already been stronger as much as people were anticipating that. But again, we haven't seen
even with the $200 billion in liquidity that the Bank of Japan flooded into the system.
Right, exactly. But it has not reared its ugly head in the corporate bond market and damaged that. Again, it's been fairly localized, and we've had a movement broader across the spread market, but it's not been significant.
We've been talking kind of about sectors with you, insurance, energy. Let's throw out a couple of specific names, when we think about these sectors. We've talked a lot about, generally here at Bloomberg, about AFLAC. I mean, what is something you're seeing in there in terms of the corporate debt market?
Well, AFLAC spreads were out the most of any of the insurance companies, out roughly 60 basis points in the intermediate sector, Carol. But again, I'm already seeing signs that people are dipping their toes in and looking to buy spreads wider. Also, in the energy sector, we saw Pacific Gas and Electric 605s of 2034 widen out 25, 30 basis points, and already they're starting to come back in.
So what kind of news flow, Michael, do we have to see potentially over the next week or so that says, well, this may be more lasting?
I don't think we're going to see anything definitive over the next couple of weeks. Again, this is going to take a long time. The energy issues are going to be political. I mean, President Obama wants to have nuclear energy. It was political
before. It's even more political now.
It's really politicized now. So he wants cleaner energy, and the nuclear power is the way to go. We don't have the alternative renewable energy sources right now to replace that.
Everybody in Tokyo gets sick from radiation poisoning.
That will definitely put that industry more in limbo. But I mean, there's political motive and energy to move this forward. Right now, we can't just say, okay, we're going to shut down all our nuclear power plants, because we don't have a replaceable energy source to take up that slack right now.
That's interesting that you say that. But in terms of renewable energy, anything in the corporate bond market that we're seeing that people are all of a sudden again focusing on that side of the market? We've certainly seen it play out in the equity side of things. What about in the corporate bond market?
In the renewable energy sector, in the corporate market, is largely a high yield, less liquid. Then you're going to see these very larger issues, whether it be in AFLAC or some of the other insurance companies, where you're going to see more movement, more transparently. The high yield sector is going to be less actively traded.
It sounds like, though, in general, there's a lot of action in the corporate debt market right now. I mean, we see even more volume in equities, which volume has been anemic, obviously, in the equities market. But you've got some conflicting forces that seem like they would create a lot of volume in corporate debt as well.
Yeah, it's actually been kind of nice to see the pickup in corporate debt. I mean, most of in the secondary trading, there's been a great deal of new issuance in the corporate market. That's been the story for the first 3 months of this year, is new issue driven. But this is the first time we've gotten to see some secondary market volatility.
Do you expect to see a lot of new issuance coming out of the rebuilding here? I mean, it would seem to me that a lot of cash needs to get raised.
That could very well come from Asia and from specifically Tokyo. That's going to take a while for them to assess what their situation and what their needs are. Right now, I don't think it may temporarily interrupt issuance in the United States, but I think it will resume very quickly. Again, this is the segment before. Someone was talking about, is there panic selling? This is not panic selling. This is not anything like the Gulf oil spill.
So what do you advise to investors at this point? I mean, again, you're saying, hold on, we don't really have enough information. It's still very kind of early in the game here as we try to assess the situation. So what do you say? Maintain your positions at this point?
It really depends on whether you like to sleep or not. Carol, I don't mean to make light of the situation, but everyone has a different risk profile. So I think, look, we've already started seeing people enter into the market here and buying at wider spreads. Complaints have been, well, corporate spreads not only are yields so low, but corporate spreads are so tight. We're still 30, 40 basis points off the all-time tights in the corporate spreads. But I think people are going to start to come back into the market.
Have the risk metrics changed so much because of Japan in the last couple of days?
I don't think overall in the corporate bond market, no, it hasn't. I think it's specific a couple industries, but overall, I don't think the corporate market has changed. And I think you're seeing, like you said, a knee-jerk reaction here to the volatility across the commodity markets, the interest rate markets, and the equity markets.
So, but generally, you're saying then visibility hasn't changed much either, because I'm thinking if you want to get some sleep, maybe you wait until a few things happen and you get more visibility out.
Right. I think that's what will happen. This is going to take a while for us to really, truly understand what the impact in the U.S. energy, nuclear power sector is going to be. It's going to take months and months. We're going to see regulatory issues. We're going to see lots of hearings.
And as Mark Grant from Southwest said earlier, I mean, he doesn't necessarily trust all the information that's coming out of Japan at this point, so the picture gets even easier.
I can't really comment on that. But I can see where that would be the case.
Shocking. He doesn't take every word out of TEPCO for the gospel? No. All right, Michael, thanks so much for joining us. Michael Mutti, Raymond James Senior Credit Strategist.